Hello students, I am Dr. Manish Puntambekar from the Department of Management, BSSS Bhopal. Today we will just talk about funds flow statement. Some of the most important features of funds flow statements are as under. So, students will understand today this funds flow statement. This funds flow statement is a statement which shows the movement of funds into or out of business. This is the first and most important characteristic of this funds flow statement. Second, in other words, it is a source and application of funds. It means there are two parts of this funds flow statement. One is called sources and other is called uses. Then third, here funds means net working capital, which is the excess of current assets over current liabilities. Working capital is always used to pay day-to-day expenses of our business, and it is also the difference or excess of current assets over current liabilities. Fourth point is, it is also known as statement of sources and application of funds. Now students, we'll understand the objectives of funds flow statement. Here, the first and most important objective is to find out the position of the working capital on two dates of balance sheet. Actually, we always take into consideration here a balance sheet of 2 years, that is at the end of the year. So, we will just find out here the position of working capital between these two dates. Next is to know the changes in working capital during the period. What are the changes in working capital? Has it been increased or reduced? We'll just understand. Third point is to know the cause of changes in working capital. There are so many causes in changing working capital. So, we'll understand here the causes, the main causes. Now, fourth point is to know the inflow of funds according to their sources. So, we'll just here understand what are the main sources through which we can generate funds in the business. And last, the fifth point is to understand the main features of financial operations and policies. Here we have to prepare some tables, in which the first and most important table is schedule of changes in working capital. Through this schedule of changes in working capital, we can come to know exactly the increase or reduction in working capital. Here, this schedule of changes in working capital, in which the first part is particulars, first column is particulars, in which we will just show here previous year and current year's income. In this previous year and current year's amount, actually, the purpose is what? It has to be find out only the increase and decrease in the components of working capital. So, here the part of working capital, basically there are two types of working capital, gross working capital and net working capital. Here gross working capital is the total of only current assets. If we subtract all the current liabilities from all these current assets, so we will find their net working capital. So, in which all these are the different types of current assets like cash in hand, cash at bank, bills receivable, sundry debtors, marketable securities, loans and advances, stock and prepaid expenses. Now, current liabilities. Under current liabilities, all of you know that current liabilities are those liabilities which have to be paid within one financial year. So, those liabilities include, first of all, bills payable, sundry creditors, outstanding expenses, advance received, bank overdraft, short-term advances, proposed dividend and provision for taxation. So, all these are our current liabilities and these are current assets. If we deduct all these current liabilities from all these current assets, finally, we will just find out their working capital. And now, the difference between increase and decrease, whatever the difference is there, either it may be increase in working capital or it may be decrease in working capital. Now the second most important table, it is called profit and loss adjustment account. In this profit and loss adjustment account, the basic purpose of preparing this to find out either we are generating funds from operation or we are losing here funds in operation. Here the first, all these are non-cash and non-operating expenses which have to be written in the debit side, like depreciation, then goodwill written off, advance suspense preliminary expenses, to loss on sale of fixed assets and investments, then to premium on redemption of preference shares and debentures, to general expenses, to provision for tax, to proposed dividend, to interim dividend. So all these are our non-operating and non-cash expenses of the business. And in this side, we will start it from, this is opening balance of profit and loss account, because this opening balance of profit and loss account is the previous year's balance of profit and loss account, and ultimately we will just close this statement at closing balance of this profit and loss account. In this credit side, after showing this by balance brought down, that is the opening balance of profit and loss account, this is the profit only, and all of you know that profit and all liabilities must have always credit balances. Therefore, the opening balance of this profit and loss account will always be shown at the credit side. Apart from this opening balance, by profit on sale of fixed asset and investments, by dividend received, by rent received, by funds from operation, which is the balancing figure. It means this is the balancing figure which shows how funds are being generated during the year out of business activities. So actually this is the credit side, and in this credit side we always put all non-operating and non-cash incomes. Now finally we will understand here the format of funds flow statement, in which there are two sides. First it is sources and second side is applications of funds. Here actually we will just find out how funds are coming in the business, are being generated through all the activities in the business. So here first of all, this trading profit on funds from operation, actually this is our trading profit, or we can also say this is our funds from operation, which is already calculated through this profit and loss adjustment account. With the help of this profit and loss adjustment account, then issue of share capital, issue of debentures, raising of long-term loans, sale of fixed assets and investments, non-trading receipts, that is dividend, etc. And finally, net decrease in working capital. It is one of the sources of this working capital funds. Therefore, this is the most important term, which is called net decrease in working capital, which has already been calculated from the help of schedule of changes in working capital. Now students, we will understand here the second part of this funds flow statement, that is application side. In this application, first of all, this funds lost in operation, this application shows actually how we are just incurring funds in our business. So the first and most important point is what? This is funds lost in operations. Okay. Then redemption of preference share capital, redemption of debentures, repayment of long-term loans. So all these are our redemption of shares and debentures, that is also called long-term capital, right? Then buyback of equity shares, purchase of fixed assets, payment of dividend, payment of tax. So all these are our applications of funds. And finally, this is the most important thing, this is called net increase in working capital. Net increase in working capital is one of the uses, or we can say applications of funds. Now students, we will understand here one numerical question. According to this question, the following are the condensed balance sheets of B Limited at the end of 31st March 2020 and 21. Here these 2 years balance sheets are given, 31st March 20 and 31st March 21, which is called previous year and it is current year. Here under this equity and liabilities, we have been given here first of all shareholder funds, in which share capital, equity shares of 10 rupees each fully paid, which is amounted to rupees 2,50,000 and 3,50,000. It means there are total 25,000 equity shares and 35,000 equity shares of 10 rupees each. Reserve and surplus, it is amounted to 150 and 140,000. It means we see here it has been reduced by 10,000 rupees during the year. Second is non-current liabilities. Under this non-current liabilities, long-term borrowings are given, in which 6% debentures are given. In previous year it was rupees 50,000 and now it is only 20,000. It means during the year we must have redeemed total 30,000 rupees worth of debentures. Then long-term provisions, under which provision for depreciation is given. So earlier the provision was only 80,000 and now it is being shown 1 lakh rupees. It means during the year we have provided 20,000 rupees extra for this provision for depreciation. Next is trade payable, that is actually part of current liabilities. Under this trade payables, actually so many other liabilities, short-term liabilities, short-term outstanding expenses may be included. So here it is trade payables, this amount 116,500 and 133,000, it means it is being increased. Then other current liabilities, which include outstanding expenses, unpaid dividend, so both these are our other current liabilities. And finally short-term provisions are given, in which the first is provision for tax. Provision for tax has been shown worth rupees 30,000 and here it is 25,000. Okay, so it means it has been reduced by 5,000 rupees during the year. So we will see what is the impact of reduction of this 5,000 rupees in this provision for tax while solving the question. Then next is provision for bad debts. Earlier it was 13,000 and now it is 18,000. It means during the year we have increased it by rupees 5,000. In the asset side, we have got here two types of assets. First, non-current assets and second is current asset. In non-current assets, first of all, property, plant and equipment. So in this property, plant and equipment, land and buildings are worth rupees 125,000 and 125,000. It means there is no change in land and building. Second is plant and machinery. It is 240,000 and 3,60,000. It means during the year we must have purchased some plant and machinery worth rupees 1,20,000. Then after this, some current assets are given. All of you know the meaning of current assets, which are short-term assets of our business, in which inventory, trade receivables, cash and cash equivalents and other current assets like debenture issue expenses are given here. I'll just tell you what is the meaning of this debenture issue expenses. Apart from these balance sheets, we have been given some additional informations also, which say the first point, income tax paid in 2020 was rupees 35,000. It means during the year, company has paid total 35,000 rupees as payment of income tax. Second, an old machine was sold for rupees 44,000. Actually, it is the selling price of this old machine, the cost and written down value of which was rupees 60,000 and rupees 40,000 respectively. It means it had cost rupees 60,000 to us and its written down value is rupees 40,000. It means we have used it up to rupees 40,000 and its cost was rupees 60,000. So actually this 40,000 is the written down value, but it is being sold for rupees 44,000. It means we are earning rupees 4,000 from sale of this machinery. So we will understand this profit on sale of this machinery through preparation of this machinery account. Then third is bonus shares at 2 for every 5 equity shares were issued out of accumulated reserve and surplus. So while solving this question, I'll explain you how to issue these shares. Okay. Next is fourth point. Out of the proposed dividend of rupees 32,500, company has already proposed this total dividend of rupees 32,500, out of which for 2020 only 30,000 rupees has been paid in 2021, and in addition to that an interim dividend of rupees 25,000 paid in the same year. Here there are two types of dividend in this question. The first dividend is proposed dividend and the second dividend is interim dividend. Both the dividends we are paying to our shareholders. Then fifth point is debenture interest paid rupees 3,000. It is also one of the expenses of us. So while solving this question, I'll just tell you where it should be written in this question. On the basis of all these additional information, we have been asked to prepare this funds flow statement. Now students, we'll try to understand this statement showing changes in working capital. Here, this statement shows total current assets and total current liabilities. Here, 1,90,000 in the previous year and 1,93,000 in the current year as far as this inventory or stock is concerned. This 190 and 193, it has been increased by rupees 3,000, whereas this trade receivables have been increased by this 19,000 rupees here during the year. And as far as cash in hand is concerned, cash in hand has been reduced by rupees 25,000 during the year. Apart from all these current assets, some current liabilities now we'll just understand. Under current liabilities, sundry creditors are rupees 116,500 and 1,33,000 respectively. This amount has been increased by rupees 16,500 during the year, right? Then outstanding expenses. So outstanding expenses are also being increased worth by rupees 8,000, and provision for bad debts. Provision for bad debts have been increased during the year by rupees 5,000. So ultimately, total of this decrease side is total 54,500, and we see the total of this increase side is only 22,000 rupees. So if we take the difference 54,500 minus this 22,000, so there is a balancing figure of rupees 32,500. That is actually this is decrease in working capital. We see here during the year total 32,500 has been decrease in our working capital. So this is the result of preparation of this statement showing changes in working capital. Now students will understand how to prepare this funds flow statement for the year ended 31st March 2021. As far as this funds flow statement is concerned, there are two sides. First side is called sources and second is application. First of all, let us understand the sources. Here, most important source is funds from operations, which we will understand through this working note. So, to understand this funds from operation, we will have to prepare this profit and loss adjustment account. This profit and loss adjustment account, we can say this is profit and loss, which shows actually the opening and closing balances of profits during the year. So opening balance, all of you know that profit and loss means this is our profit only, and profit must have always credit balance. Therefore, we will start this preparation of this profit and loss adjustment account from the credit side. So opening balance is rupees 1,50,000 and closing balance is rupees 1,40,000. So both these are already given in the balance sheet. Now, in this profit and loss adjustment account, in the debit side, we will have to just show all these non-cash and non-operating expenses of the business, in which the first is debenture issue expenses, which are already given in the question, then debenture interest, which are not regular expense of the business, then interim dividend, provision for depreciation, provision for income tax. All types of provisions are called non-cash and non-operating expense of the business. Apart from this, bonus and dividend, these are also not regular or recurring expense of our business. So all these are our non-operating and non-cash expenses which have already been written in the debit side and now credit side. In this credit side actually we'll show all non-operating and non-cash incomes, in which the first is profit on sale of machinery. So whenever we'll just prepare this machinery account, all we will understand how we have calculated this 4,000 rupees. So this is actually the part of working note. And then finally this funds from operation can be calculated, because the total of this debit side is rupees 3,80,500, out of which this 150 plus 4,000, if we deduct total 1,54,000 rupees there. So finally this 2,26,500 rupees will be left, which will be called funds from operations, which is one of the most important sources of us. Now we will understand here under this funds flow statement. Already we have discussed how to calculate this funds from operations, and now we will understand this sale of plant and machinery worth rupees 44,000. So to understand this sale of plant and machinery 44,000 rupees, actually we have to prepare one account which has already been prepared on this board in this slide. So first of all, this plant and machinery account we are just going to prepare. All of you know this plant and machinery is one of the fixed assets of us. So all fixed assets must have always debit balances. We will start it from the opening balance as to balance brought down, which is amounted to rupees 2,40,000. It means at the beginning of the year the amount was rupees 2,40,000. The value of plant and machinery was rupees 2,40,000, and at the end it is total 3,60,000. So these two corners have already been provided as an additional information in the question. Apart from these two corners, now plant and machinery during this year, actually we are just going to sell the part of this plant and machinery actually for rupees 44,000, and its cost was rupees 60,000, and it has been depreciated to rupees 40,000 during the year. It means 40,000 rupees up to rupees 20,000, the difference of cost price and written down value worth rupees 20,000, which has already been used by the company, and now the written down value which has been shown in the question, it is only 40,000, sorry, and this 40,000 rupees worth of plant and machinery, it is being sold for rupees 4,000. So there is a difference of 4,000, which is one of the profits of us, and we have already earned this 4,000 rupees worth of profit. It has been shown in the debit side as to profit on sale of machinery account. Okay, now this provision for depreciation, you know, the total cost price of the machinery was rupees 60,000 and its written down value is given only 40,000. It means the difference of 20,000 rupees is what? It must have been provided for depreciation only, obviously. So this 20,000, this is the depreciation on the part of that particular machinery which is being sold, right? So here we see that during the year this 1,80,000 will be the balancing figure, because the total of this credit side of rupees 4,24,000. So from this 424,000, if we deduct this 2,44,000 rupees, so finally we will get there 1,80,000 rupees there, and this 1,80,000 will be our balancing figure, which is due to purchase of plant and machinery during the year, which is one of the applications of funds. Now students, this sale of plant and machinery worth rupees 44,000. So this is one of the sources, because we are selling here plant and machinery worth rupees 44,000, which has already been shown here in this plant and machinery account 44,000. So this is one of the sources of funds during the year. And then one more thing, that is, you know, this purchase of plant and machinery. Purchase of plant and machinery, already we have got this figure 1,80,000 rupees worth from the help of this plant and machinery account. This is one of the balancing figure. It means during the year 1,80,000 rupees worth of this plant and machinery we have purchased, and this is called balancing figure. So it is one of the applications of funds during the year. 1,80,000 rupees we have incurred in purchasing plant and machinery. Now, this decrease in working capital, which is amounted to rupees 32,500, which has already been obtained from the help of this schedule of work changes in working capital. So this 32,500 is decrease in working capital, which is one of the most important sources of the funds, right? Then now applications. We'll have to understand the uses of funds or applications of funds during the year, in which payment of interim dividend. Payment of interim dividend during the year, company has already paid this 25,000 rupees worth of interim dividend. Then proposed dividend which has been paid by the company during the year is rupees 30,000. So this side is actually applications of fund, in which all the funds are going out from the business. So here first payment of interim dividend and then proposed dividend. Now payment of tax. During the year, company has paid 35,000 rupees worth of total tax and redemption of 6% debenture. During the year, actually total opening balance of debenture is given rupees 50,000 and closing balance is given only 20,000. It means during the year, company must have redeemed total 30,000 rupees worth of debentures. So it is also one of the applications of funds. And finally, one more figure is given there, that is payment of interest. So debenture interest has been paid worth rupees 3,000, which is also the part of additional information. So we see here that in this funds flow statement, the total of sources, that is 3,03,000, and total of applications, this is also equal, that is balanced 3,03,000 rupees. Now students, we'll understand one more account, that is provision for depreciation account. This provision for depreciation, all types of provisions are called liabilities for the business, and all of you know all liabilities must have only credit balances. Therefore, we'll start it from this credit side. So opening balance worth rupees 80,000 has already been given in the question, and this closing balance worth rupees 1 lakh, it is also given in the question. So opening and closing both the balances of this provision for depreciation account is given, but during the year this 20,000 rupees has been charged as depreciation on that part of machinery which has been sold during the year. So this 20,000, this is the actual provision for depreciation on that part of machine which is being sold during the year. So ultimately we can calculate here this 40,000, which is the balancing figure which has been transferred to this profit and loss adjustment account, and this 40,000 is what? This is actually total provision for depreciation on machinery. It means during the year, here total amount of depreciation which has been charged on machinery, we see here total this 40,000 is total depreciation, provision for depreciation on machinery account, and this 20,000, this is only provision for depreciation on the part which is being sold during the year. So the purpose of preparing this provision for depreciation account is to find out the total amount of depreciation which has been charged during the year on machinery. Now next is provision for income tax. As all of you know that all types of provisions are liabilities. Again, we'll start it from the credit side as opening balance. So this 30,000 is opening balance and this 25,000 is closing balance of this provision for income tax, right? So after taking into consideration both the opening and closing balances, now we will check here this 35,000 rupees also. During the year, we are paying here income tax worth rupees 35,000, which is the part of additional information. So the journal entry is what? This is provision for income tax account debit to bank account worth rupees 35,000. It means we have paid the amount of this income tax worth rupees 35,000. So ultimately total 30,000 rupees will be our balancing figure. It will be left as balancing figure. It means during the year, it can be said that during the year we have provided this 30,000 rupees for this provision for income tax. So there is a clear distinction between this 30,000 rupees worth of total income tax provided during the year and this 35,000 rupees worth of income tax paid. So this income tax paid is our cash expense, and this income tax provided during the year, it is one of the non-cash expenses or non-operating expenses of our business. Now students, only one thing is left in this question to understand. That is point number 3. Bonus shares at 2 for every 5 equity shares were issued out of accumulated reserve and surplus. Total share capital is rupees 2,50,000 in the previous year. Each and every share is worth rupees 10. It means there are total 25,000 shares. It is clearly mentioned over here that bonus shares at 2 for every 5 equity shares. It means if we divide it by 5 shares, so it will be equal to 5,000 shares, and just double shares means total 10,000 shares, not this rupees, it is actually 10,000 shares company is just going to issue as bonus shares. If suppose 10,000 shares are being issued as bonus shares, so ultimately 10,000 into each and every share is rupees worth 10. So it will be equal to rupees 1 lakh, and this 1 lakh rupees, this is actually one of the applications of funds, because during the year company has issued this 1 lakh rupees worth of bonus shares. So this bonus has been paid to the shareholders worth rupees 1 lakh. This is also one of the non-operating expense for the business. So it will always be shown in the profit and loss adjustment account. That's it. So students, some more numerical questions we would like to understand and discuss in next video. Thank you so much.